Hey, everybody, it's your boy, Sean McLaughlin at Options Sean on the old Twitter X. Hope you guys are doing well. Today is Wednesday, November 19, 2025. This is What Are My Options? It's generally an educational show. It's more designed to be for people to ask me questions. If you have questions about a strategy, or if you're looking at a particular stock that you're thinking about putting an options trade on and you'd like to know my take on it, or anything related to options you have questions about, that's what this is for. We're going to keep today's session short, though. Today, we only have about 20 minutes here to operate. We got some other stuff going on the channel today, so we're going to keep it short. Hi, Rachel. I see you in there. Good to see you. Um, I thought I would come in though, but while I wait for some questions, if there are any questions, I thought I would come in with a little educational piece here real quick. Um, if you want to bring up my chart here, Gene, I got the VIX chart up here. VIX is currently trading with a not trading, but indicating a 23 handle on the VIX, meaning volatility is a little bit elevated across the universe of stocks. It's not true in every stock, and that's not true in every sector, but broadly speaking, volatility is present currently in the market. And if you've been actively trading, I'm not telling you anything you don't know. You know this. All right. Well, when volatility gets high and elevated, certainly into the low 20s, that is often a time where I will start looking for delta neutral trades. Delta neutral trades are trades that don't need the market to move to make money. In fact, they prefer it if the market just kind of stays within a range. Now, there's a variety of delta neutral trades one could put on. You could put on an at the money calendar spread. That could make money in a sideways tape. You could put a butterfly spread on, an at the money butterfly spread. That can make money in a neutral tape. What I'm going to talk about today is iron condors. Okay. Iron condor is a cousin to a strangle. A strangle is a trade where you sell an out of the money put and you sell an out of the money call, and you hope that you hope the market doesn't move too far in either direction, and those options that you sold will decay away, and you could cover them for cheaper than what you sold them for. Well, an iron condor is similar to a strangle, except that it's protected. There's defined risk. A lot of people don't like selling naked strangles because of the fact that there's undefined risk, right? You could have a big gap in either direction that could really cause havoc on your trade and on your profitability and on your P&L, right? With that iron condor, at least you can have the comfort of knowing your risks are defined. So let's do it real quick. Let's walk through an example of what an iron condor looks like. We'll just use the S&P 500, SPY. So I got the options chain here on my chart. This is Tasty Trade software, one of the softwares I use to trade. And generally speaking, when I'm putting on any kind of short premium trade, this is not true all the time, but generally speaking, I like to look about 30 to 60 days out to expiration. Well, the December monthly expiration as we speak right now is 30 days. So that's right on the cusp. Let's just go with December, okay? And maybe I should take a step back and explain why do I like to put on short premium trades between 30 to 60 days of expiration. That is because when you're in that window of 30 to 60 days, there's still plenty of premium in those options. But now you're getting to the point in time in the options life cycle where theta decay, that is the decay of premium, begins to increase its daily rate of decline, right? If an option has 8 months to expiration or a year to expiration, it's not going to lose much value, all else being equal, right? If the stock doesn't move, that option's not going to lose much value on a day-to-day basis because there's so much time to expiration. But once you get closer to expiration, whatever premium is in those options, they're going to start decaying at a more rapid rate each day as you get closer to expiration. So that 30 to 60 day window for me is when there's still plenty of premium in the options, but now they're going to really start decaying in my favor as someone who is short premium. So let's use these December options that expire in 30 days. Let me open up the options chain. Now, there's no perfect way to set up an iron condor. Okay, you can bring your strikes in a little tighter, you can make them a little bit wider. There's no perfect answer here. It comes more to your comfort level and what kind of probabilities you're looking for of success. When you put on any kind of delta neutral credit spread, you're playing a game of high probability. You're not playing a game to make big gains. Okay. This is not a big gain strategy. This is a high probability strategy where you're going to win if you're doing it right. You're going to win more often than you lose. And your wins are going to be small. Your losses might be a little bit larger, but if you apply proper risk management and honor stops, things like that, you can skew the odds in your favor so that over time, if you do a number of these trades, they will work out in your favor. So, generally speaking, again, this is not always true for me, but when I'm putting on an iron condor, especially in an index like SPY, ooh, let's take another step back. This is important. It's less important for your iron condors. It's important for naked strangles. But also, generally speaking, when I'm putting on delta neutral trades, I like to stick with either ETFs or very large cap stocks. You know, think like Apple, IBM, Microsoft, Amazon, like the really big micro cap or large cap stocks, because they're not going to have they're less likely to have a sudden large gap against you, right? And the ETFs, especially because those are, blended products that there's a bunch of stocks that make up that index. So you're not at risk of a sudden gap against you because of a news item in a stock that crashes the stock 50% overnight. All right. So generally speaking, stick to ETFs or mega cap stocks. Okay. Sorry, I had to get that caveat out of the way. All right. So now when I'm putting on an iron condor, we're going to use the SPY. I like to anchor my short strikes. Again, this is going to be a four-legged spread, but the short strikes are the key because that's what's paying me, right? So I want to be far enough away to get premium, but not too far away that I can't get much. I generally like to look around the 20 delta strikes for the calls and puts. So let's scroll down here. You can see the delta here. These are the puts on the right side of my screen. You can see the delta in this column here. I'm going to scroll up until I get to about the 20 delta. Here's a couple options with a 20 delta. I do like to stick with kind of big round numbers here. So we'll cheat a little bit and we'll select the 625 put. Okay. It's got a 21 delta. All right. By the way, Tasty Trade makes this real easy to put together multi-leg spreads because all you have to do is click on the option and it selects it. And then I want to protect this. I'll just protect the 10 bucks away. We'll do the 615 put. I will buy that. So I've got the two legs going so far, right? I'm selling the 625 put and buying the 615 put, but there's two more legs. We got to do the call side as well. So the calls options are on the left side of my screen here. I'm going to scroll all the way up the other direction. Let's try to find the 20 delta call strike, which is right about here. We'll call it the 690. Okay, that's got an 18, but again, I like the big round numbers. Let's sell that 690 put and buy the 700, or sorry, the 690 call and buy the 700 call. And you'll notice my platform is showing me that right now I could get about a $2.87 credit for that trade. Now let's look at what this looks like on a P&L graph. Let's open up the curve. Here you go. Here's what a P&L graph of this trade looks like. You can see these are the short strikes. I'm short the 625. I'm short the 690 call. And then I'm protected at the 615 put and the 700 call. Now you can see here that my risks are defined. The most I could lose is the width of these strikes. So the 615 on the low side, the 625 up here, that's 10 bucks, right? That's the difference between the strikes is 10 bucks. I could only lose on one side. I can't lose on both, right? So you just have to think about one side. The most that spread could be worth, the most I'd have to pay to cover it if it goes away in the money, I'd have to pay 10 bucks, okay? But I'm collecting about 287 right now, right? So my max loss would be $10 minus the 287 I collect today. In this case, that would work out to be a $713 maximum loss. Now, the most I can win is the credit I collect today, this 287. If the S&P 500 SPY settles in this range here between above 625 and below 690 on expiration day, then all of my options will expire worthless, and I just walk away keeping the credit that I collected today, this 287. Okay. Now, an important thing to remember, at least the way I do it, is I don't plan on holding this all the way to expiration and earning the maximum return, nor do I plan on suffering the maximum loss if this thing goes rapidly against me. Now, I can't control whether or not I suffer the maximum loss, but it's unlikely that I will if I have a stop loss in place and act upon that when appropriate. So You can see here on my trading platform, all trading platforms are different, but these little stat here shows this P50. So it's hovering around 77, 78%. That's telling me that I have an approximately 77 to 78% chance that I'm going to be able to achieve my profit target of buying this back is 50% of the premium I collected today. So if I sold it for 287 today, I would put a good till cancel limit order in to buy it back for about 142, 143, which is half of what I collected. And if I do that consistently over time, I'll have I'll have about a 78%, 79% chance of achieving that profit target every time I put this trade out. So if I do 100 of these trades, about 78% of the time, I'm going to hit my target and make money. Great. Now, what about those other 22% of the times where you don't hit that target? Well, just because you don't hit that target doesn't mean you don't make money, but it likely means you lost, right? And so we increase our odds of success by taking profits early, right? Taking it when you earn about 50% and or stopping out if your short strikes are breached. If we get below 625 or if we get above 690, then you just close the trade and wrap it up. You won't suffer the maximum loss. You'll suffer a loss, and the amount of the loss will depend on how close we are to expiration day, of course. There's some factors that go into it. But it's likely maybe we'll lose, maybe $100 or maybe 200 bucks, as long as we don't have a big gap through those levels, right? But if we're watching this intraday and all of a sudden S&P trades up to 690 and it breaks above 690, if I were to close that spread right then and there, I might only lose $100 on the trade or 200 bucks, maybe 300 bucks at most. Okay. But if you're only losing 200 or 300 bucks on 22% of your trades, but you're making 140 bucks on 78% of your trades, I'm making up numbers here, but I'm approximate, but that math is going to work out for you over time. So I know that's a little math heavy, guys, but when the market is offering opportunities, when volatility is high, let's go back to the volatility chart. When VIX is high like it is right now, that means premiums are elevated. And that doesn't necessarily mean you're going to collect more premium if you do an iron condor, but what it does do is it widens out those strikes. So that increases your odds of success. When there's high options premiums, it means you can go further away, which is good. Ideally, you don't want either side to be tested. You want S&P to just kind of stick in that middle of that range while theta works its magic for you day after day. That's what you want. Okay. I see a question there. DPS is asking, why not do this on SPX futures? You absolutely could. You absolutely could. On futures options, you'd have to do it on futures options. An iron condor trade, you need options to do that because you're collecting that theta decay in the options. That's not something that's available in futures. But yes, you could do this in futures options, certainly. I think probably what you mean is that SPX futures, but ES futures, right? The ES contract. Either's fine. If you're a futures trader and you like to trade futures options, you can do that. There's plenty of liquidity in both. Okay. And I just picked SPY because it's a broad index, right? You could do this in the Qs. You could do this in large cap stocks, like I said, like the Amazons, the Apples, the Microsofts of the world, the big cap stocks that aren't going to just rip in your face against you. If there's a big move, you don't want that. That's, any kind of delta neutral trade, you don't want to have that risk. Ideally, you want to see a range. Like in fact, let's pull up the chart of SPY. I mean, you can see right now the SPY is kind of stuck in a range below. No coincidence that 690, which is where we're shorting, right? Let's go back here. We're shorting the 690 call. I don't believe that is a coincidence that is right about the high for the S&P 500, right? And we're selling the 625 put. Let's see where 625 put comes all the way down here. It corresponds with this low level. I don't think those are coincidences, right? But basically, we want to stay above 625 or below 690, and it looks like SPY is kind of in a range right here. So ideally, you also want instruments that look like they may be stuck in a little bit of a range, and SPY right now certainly looks like it. And there's a lot of room down there to 625. So SP could have a little bit more of a down move, which feels like it might be setting up for that. And we'd be okay. All right. All right. So I told you guys we had to keep this quick. We got another a commitment coming up on the channel here in a little bit. I don't see any other questions in here. So maybe we'll just leave it there. Guys, girls, in a market like this where volatility is offering you opportunities, volatility doesn't have to be scary as an options trader. Okay. Volatility just informs the types of trades that give you better odds of success. And when volatility is high, doing some kind of short premium trades, they increase your odds of success and they can perform very well in high volatility tape. You have to manage risk, of course. No matter what style of trading you're doing, you always have to manage risk. But don't let high volatility scare you from putting on options trades or making you put your hands in your pockets. As an options trader, you always have options. There are always things you can do. So let that be a lesson to you. If you have any questions on any of that, feel free to hit me up on Twitter. I'm Options Sean, or shoot me an email at Sean@allstarcharts.com. Happy to discuss further with you. But I'm going to take off now so that the guys can clear up the channel and get the next thing going. I'll see you guys tomorrow for the live options jam session at 3 Eastern. Take care, everybody.